China's economy is suffering from the opposite, deflation. Consumer prices declined in July for the first time in more than 2 years. People and businesses are not spending, and the world's second largest economy is struggling to revive demand.
Things are not going to plan with China's economy. Joe Biden says China's a ticking time bomb. China's in trouble. The Economist magazine talks of President Xi's failing model.
Property developers, such as the gold bar-giving Wafa Tianfu, were forced to get creative as they became increasingly desperate to attract sales.
Today, we explore why China's economic engine stalls. For decades, China's economic juggernaut has thundered across the global stage, transforming skylines, reshaping industries, and rewriting the rules of global commerce. Yet, amidst the cacophony of progress, a disquieting murmur now reverberates through the halls of power in Beijing and boardrooms worldwide. The dragon, once a symbol of unstoppable growth, now finds itself ensnared in the coils of a sluggish stride. Picture the momentum of a high-speed train grinding to a halt as the world watches with bated breath. This is the enigma of China's economic slowdown, a confluence of internal challenges and external pressures threatening to dim the beacon of its meteoric rise. Before its economic reforms were hailed as a miracle and its doors opened to the wider world, China grappled with a severe housing crisis. Urban areas in particular were incredibly congested, with living spaces comparable to the average footprint of a one-bedroom apartment in Manhattan or an average American kitchen. In 1980, the average living space per capita in urban China was below 10 square meters, only surpassing the 10-meter mark in 1985 and 15 meters in the mid-1990s. To illustrate the density, other urban areas worldwide had significantly larger living spaces in 1992, with only Tokyo, New Delhi, and Cairo coming close to the cramped conditions experienced in urban China. Beyond the issue of available space, these living conditions were also characterized by dinginess, danger, and a lack of modern amenities. In 1985, urban households in China faced significant challenges. 90% lacked piped gas, 70% didn't have access to private toilets, and nearly 40% relied on shared kitchens and water taps. Rapid demographic shifts, corruption, and widespread poverty all contributed to China's housing crisis. However, the fundamental issue was the lack of strong incentives for construction. During the 1980s, housing in China was primarily the responsibility of the state. It was either managed by local government housing administrations or provided by state-owned enterprises, and regardless of the source, it was inexpensive. Rent, considered a basic right, typically amounted to only 1 to 3% of average income and wasn't tied to construction or maintenance costs. While this approach aligned with ideological principles, it made convincing central planners to invest in additional housing challenging. Unlike infrastructure or heavy industry, housing didn't offer substantial revenue opportunities. With the state obligated yet uninterested and private development prohibited, China's housing situation deteriorated. Then Deng Xiaoping arrived, ushering in a real estate revolution. The beginning of China's decades-long development surge can be traced back to a seemingly insignificant addition to Article 10 of Chapter 1 of the Constitution in 1988, stating that land use rights could be transferred legally. While this change may have appeared vague amidst the era of economic reform and miracles, it proved pivotal. Unlike in countries with freehold systems like the US, where individuals can own land outright, all land in China is owned by the state or rural collectives, a structure unchanged before and after the reforms of the 1980s. However, this amendment created opportunities for intermediaries. While the state retained ownership of the land, it delegated the right to use and develop it to local and municipal governments. Seeking to boost revenues for infrastructure or operational needs, these local governments could now sell these land use rights to property developers. In turn, developers catered to a burgeoning Chinese middle class with increasing purchasing power, meeting the demand for housing. This shift transformed housing from a state-mandated necessity to a lucrative opportunity. Local governments gained stable income streams through land sales, developers capitalized on soaring demand, and urban Chinese with growing wealth found expanded housing choices and investment prospects. Suddenly, what hadn't existed just years before, a private real estate and development sector was red hot. Urban living space shot upward. So too did home ownership. From 1998 through 2002, Chinese developers built enough stock to house the entire population of the US. Amid an economic miracle, a housing miracle, two things that couldn't be separated, as housing development didn't track alongside economic growth, but helped fuel it. According to the Sovereign Wealth Fund Institution's rankings, of the world's top 10 largest real estate companies by total assets, 6 are headquartered in either mainland China or Hong Kong, but doing much of their business in mainland China. Of these, 4 of the largest land development companies the world over were founded in the 1990s or later, making their rise from nothing to the world's biggest in a construction-based industry, nothing less than meteoric. Certainly, this rise can in part be explained by simply stepping in and filling an extreme void in supply, but it also has to do with strategy. Take the largest, for example. Evergrande's rise effectively began with this project when a 110,000 square meter footprint, formerly the home of a pesticide plant, came up for sale in the Haizhu Industrial District. Turning the cheap land into aspirational apartments for a growing aspirational middle class, the project sold out in just 2 hours. Immediately, the company reinvested the earnings into 13 new projects across Guangzhou, and the push toward the top was unmistakably on. They weren't alone either, as uniform high-rises seemingly copied or pasted rose high into the sky around burgeoning cities and industrial areas. While the outside world perceived it as a boom, Evergrande's internal operations resembled more of a frenzied race. To stay competitive amidst soaring demand and vast opportunities, Evergrande adopted an exceptionally high-leverage strategy. Similar to other property developers, they financed construction through a blend of upfront buyer payments and loans from banks. However, their distinctive approach involved assuming an extraordinary level of risk. Rather than maintaining significant cash reserves to cover potential slowdowns in sales or waiting for one project's profitability before taking on additional debt for the next venture, Evergrande pursued maximum debt and rapid construction. Despite the considerable risk, their strategy consistently paid off as projects consistently sold out. Expansion accelerated rapidly as Evergrande ventured nationwide, initiating hundreds and eventually nearing 1,000 projects by the 2010s. As private developers proliferated construction, housing prices continued to climb, with buyers typically providing down payments exceeding 35%, far surpassing norms in other developed nations, signaling ongoing prosperity. This impact extended beyond corporate growth. Evergrande's model provided the Chinese public with a rare opportunity to invest in an asset demonstrating consistent growth. It also served as a significant revenue source for local governments, facilitating infrastructure development and social services while simultaneously generating millions of jobs in one of the world's most dynamic construction sectors. Thus, what was once a crisis evolved into a cornerstone of one of the world's most robust economies. Despite years of unprecedented growth, the housing sector in China struggled to fulfill its primary function of providing adequate housing. The rapid expansion inevitably led to exorbitant prices, with property prices per square foot in major cities like Beijing, Shenzhen, and Shanghai rivaling those in major global cities like Los Angeles, Paris, and London. However, this disparity was stark in an economy where average incomes lagged far behind those in the US, France, or the UK, typically ranging between a fourth and a sixth of their counterparts in these countries. While many cities globally are known for the mismatch between income levels and the cost of living, the situation in Chinese cities was particularly extreme. For instance, in 2018, it would take an average person 41 years of income to afford an average house in Shenzhen, an almost unattainable prospect. The ratios were even worse in Shanghai and Beijing. Of greatest concern to China's central government was that this issue didn't seem to stem solely from high demand outstripping supply, despite record-high development rates. Astonishingly, nearly a quarter of the country's housing units remained unoccupied, representing millions of habitable yet empty apartments. It was perplexing for a country to simultaneously experience some of the highest housing development rates, the highest price growth rates, and one of the highest housing vacancy rates worldwide. Unless, of course, one draws the rather obvious conclusion. The value of housing in China had shifted away from its practical use as shelter to its appeal as a wealth storage asset, traded predominantly for its financial potential rather than its residential purpose. While this trend is increasingly observed across affluent nations, the extent of the phenomenon in China was particularly pronounced. By 2018, a staggering 87% of home buyers already owned another residence, indicating that many purchases were made primarily as investments. From the central government's perspective, this posed two significant challenges. Firstly, escalating prices made it increasingly difficult for anyone other than the wealthy to secure housing, leading to consequences such as labor supply shortages even in high-demand areas. Secondly, the rapid expansion of the market alongside high vacancy rates signaled that property prices had surged far beyond their intrinsic worth. These inflated prices were not justified by the actual utility of the housing or constrained supply. Rather, they relied heavily on the belief that prices would continue to soar. In essence, the housing market had inflated into a bubble. Therefore, the crucial question became not if, but when and how to intervene to prevent a catastrophic burst. The turning point came in August 2020 when the central government introduced three stringent guidelines, known as the 3 Red Lines, for the property development sector. These rules aimed to curb financial risks by imposing strict limitations on developers. Firstly, developers were prohibited from holding liabilities exceeding 70% of the value of their assets. Secondly, their total debt couldn't surpass the company's equity. Thirdly, developers were restricted from accumulating short-term debt exceeding their cash reserves at any given time. Even if a developer adhered to these red lines, their annual debt growth was capped at 15%. However, if they violated any of the red lines, the growth cap was reduced to 10%. For breaches of 2 red lines, it further dropped to 5%, and if all 3 red lines were violated, developers were barred from increasing their debt obligations altogether. These regulations weren't merely theoretical threats. Evergrande, for instance, faced challenges as it exceeded the debt-to-liability ratio of 81% and fell short in the cash-to-short-term debt ratio, violating 2 red lines. Moreover, their net debt-to-equity ratio stood at 99.8%, dangerously close to breaching the 3rd red line. Evergrande found itself in a predicament with millions of apartments already sold to buyers but left unfinished. To fulfill their obligations to builders, suppliers, and others involved in completing these projects, they needed to borrow more money. However, facing new restrictions due to their violation of the 2 red lines, they were unable to do so. Consequently, their cash reserves dwindled, while their existing obligations remained unchanged, leaving them with little capacity to launch new projects or reverse their course. Meanwhile, China took a distinct approach to COVID-19 compared to other major economies. While much of the world began to return to normalcy with the rollout of highly effective mRNA-based vaccines, China opted for domestically produced traditional vaccines, which were generally less effective. To combat persistent outbreaks, the country maintained stringent COVID-19 policies, leading to a decline in overall economic productivity. This downturn disproportionately impacted the entire economy and individuals' finances. Simultaneously, China's migrant worker population underwent a reversal. Many individuals who had previously migrated from rural areas to cities in search of better economic opportunities returned home during the pandemic. This marked the first time in recent history that the number of migrant workers in cities declined. While the decrease in demand for labor in cities during the pandemic played a role, high housing costs also deterred individuals from remaining in urban areas, despite higher salaries. Furthermore, decades of demographic changes began to manifest in China. The long-term decline in birth rates meant that individuals in China's key home-buying age group, typically around 29 years old, comprised a diminishing proportion of the overall population. Even if the total population remained stable, the proportion capable of purchasing homes began to shrink, posing additional challenges for the housing market. Evergrande found itself in a dire situation as it struggled not only to secure additional debt, but also to generate revenue through new project sales. These two crucial stages in its revenue cycle were no longer functioning as effectively as before. However, the company still had debts to settle and unfinished apartments to complete, leaving it with no choice but to seek alternative sources of cash. In a puzzling move, Evergrande ventured into electric vehicle manufacturing in 2018, a decision further compounded by the inclusion of a major senior care division. In 2021, the company sought to court Xiaomi for a potential majority stake acquisition, but talks ultimately stalled without reaching a deal. Similarly, attempts to find buyers for its stake in the successful Guangzhou FC soccer club were unsuccessful, despite the club's financial losses costing Evergrande hundreds of millions of dollars annually. Although Evergrande managed to sell its 18% stake in an entertainment joint venture with Tencent for $273 million, this sum was insignificant compared to the company's overall financial needs. The downward spiral commenced on Monday, December 6, 2021, as the grace period for overdue bond payments expired without any payment or explanation from Evergrande. Subsequent days passed without resolution, leading Fitch Ratings, one of the world's leading credit rating agencies, to declare Evergrande in default by Thursday, with investors left unpaid. The declaration of default by Fitch Ratings effectively served as a formal warning to the financial community against lending money to Evergrande, signaling the significant risk of non-repayment. For a property developer heavily reliant on debt, defaulting on loans marked a critical juncture nearing the end of the line. Even if Evergrande managed to secure loans, the exorbitant interest rates necessary to offset the lender's risk would render property development financially uncompetitive compared to market standards. Despite being viewed by many as too big to fail due to its vital role in the Chinese economy, Evergrande did not receive a bailout from the Chinese Communist Party, CCP, to avert an economic crisis. Instead, over a year or two, the company attempted various measures such as debt restructuring, asset disposal, and cost reduction to stay afloat. However, these efforts proved futile. In January 2024, a Hong Kong court determined that Evergrande was beyond salvaging. The cycle could not be restarted, and the only recourse was to liquidate the company's assets and distribute proceeds to creditors to the best extent possible. But the crux of China's challenge is that this isn't just an Evergrande issue. While it was the largest, most dramatic example highlighted in international media, the forces that slayed the giant are putting pressure on almost every single Chinese property developer. Country Garden, another giant, appears just months behind Evergrande, and after years of life support is teetering towards liquidation. Dozens of other developers are in default, and over $100 billion of debt payments from the Chinese property sector have failed to get paid. There are quite several forces putting pressure on the Chinese economy: their demographic shift, their deindustrialization, their increasing insularity. But the way the property sector has weaved itself so integrally through the nation means it serves to magnify every single one of those issues. At base, the fact that the sector accounts for an outsized portion of its gross domestic product means it simultaneously can account for an outsized drag on gross domestic product, but it also has a propensity for negatively impacting the demographic of people most central to China's economy. Stock market crashes, for example, have an impact on all, but impact those who have a higher portion of their income in the stock market most, which tends to be wealthier individuals and institutions. The Chinese property sector serves as a significant source of savings and investment for the nation's middle class. This demographic often has a substantial portion of their wealth tied up in properties, such as an Evergrande apartment that may now never materialize. Consequently, a considerable amount of money has effectively vanished, leaving a significant void in the Chinese economy. The collapse of the Chinese property sector was inevitable. Its foundation, built on highly leveraged debt, was inherently weak and unsustainable, especially outside periods of rapid growth. Therefore, a crisis of some sort was bound to occur sooner or later. What is unfolding in the Chinese economy can be likened to a controlled demolition. However, this situation presents a uniquely delicate position for the central government. The implicit social contract in China entails individuals sacrificing personal liberties in exchange for collective economic prosperity. While dissent exists, a substantial portion of the population embraces this social contract, particularly given the historic success in lifting millions out of poverty. However, if Xi Jinping's administration fails to uphold its end of the bargain and economic prosperity diminishes, it raises doubts among the populace about why they should continue to adhere to their side of the contract.